Hello, welcome to BQ Prime. You're watching earnings with BQ, and joining me is Nitin, Rakesh, CEO and MD of Mphasis, and Manish Dugar, the Chief Financial Officer of Mphasis. Gentlemen, good morning and from India, and I think good evening in the US for you. Uh, let's start off with the revenue. I think the street was expecting a little better revenue on a CC basis. Uh, you came in at 3.1% on a quarter to quarter, which is a degrowth. What was the reason for that?
I think the nuanced approach will give you a little bit more color. If you look at the overall headline number, I think you will see that the headline number has suffered. And I think the reason why I call it the nuanced approach is there's a duality of businesses at play. On one side, I think our core business, applications, US-centric, BFSI, and non-BFSI new verticals, they're all actually growing well. What's happening is the seasonality as well as the cyclicality that is playing out in the mortgage business has actually hurt the overall headline number. I think you're aware of the fact that we have a mortgage servicing line under digital risk. That business is kind of reflective of the total freeze up of the US residential real estate market and concurrently the real estate finance market. And I think that drove a significant decline on a quarter-on-quarter basis. And I would say that more than the headline decline is actually coming from that business. So that's the reason I know we're breaking out a number of our metrics, X DR as well, as we speak about the details numbers. So let me give you some numbers. If I look at the direct business XDR, the year-over-year growth has been around 15%. It has actually sequentially grown as well. Our BFSI business, especially BFS business, continues to be market-leading growth despite a seasonally weak quarter in Q3, stripping out the impact of the mortgage business as well. I think the lead indicators are all fairly positive, whether it is pipeline, which is up 27% year over year and 6% sequentially. Our deal wins of 401 million are the second highest on record. The internal of the deal wins are fairly, well balanced as well. BFSI is almost 60% of that. So I think the weakness that you're seeing really can be isolated down to the extreme cyclicality at play in the mortgage market in the US.
The US pain is expected to stay there for a couple of quarters more, means as the Fed keeps on tightening and it gets into the range of comfortable inflation rate. Do you see this business to be weak in the coming quarters?
I think two things to note. Firstly, this business is now less than 9%. It's kind of high single-digit percentage of revenue. It's already seen almost an 80% decline in volumes in the origination space because nobody's really refinancing homes and not many people are going out and buying new homes and taking new mortgages given the interest rate situation. However, there are other parts of the business that might actually free up a lot sooner. We have a home equity line of business that has actually done well, and that's the reason why, despite 80% reduction in purchase volumes, origination volumes, we are still actually seeing that the overall revenue decline is not nearly that much. So I think that business has given us a little bit of diversification away from origination. We also have another line of business on servicing, which we think will recover the fastest, even without the interest rate cycle turning, because as the delinquencies go up, with the current interest rate environment and inability of borrowers to pay, that will start opening up a secondary market for loans to be traded. That brings us the servicing line of business, which we believe will open up in the next quarter or so.
So you're saying that either end of Q4 or Q1 is when you see some kind of recovery coming in, and your existing line of businesses can compensate for this decline in mortgage coming another 2 quarters? Is that what you're saying? The pain you're talking about?
Yeah, I think again, given that it's now high single digit of percentage of revenue, the incremental impact obviously will continue to get muted. So the overall headline number will not suffer nearly as much as it did in Q3. I think Q3 was kind of a perfect storm quarter with seasonal weakness, furlough quarter. Add on top of that the massive decline that we saw in the mortgage business. But despite that, the core business continued to grow well. And I think that the core business growth will continue to make sure that the impact of the remainder of this business will also continue to get muted. So I think I wouldn't hazard a guess as to when the US cycle will turn. But I can tell you that from a portfolio of businesses perspective, what we really try to do is focus on the micro, grow what we can grow really rapidly, sell as many large deals as we can, drive the new engines of growth outside of banking, and in the new verticals that like healthcare that we seeded over the last couple of years, and that's kind of what we're focused on.
What about insurance? Because that too saw some kind of degrowth in the quarter.
Yeah, I think marginal
Where-
degrowth based on the seasonality impact. We actually had a very interesting large deal in the insurance space that we did sell this quarter. Our pipeline in insurance is also fairly healthy. At this point in time, I think the insurance business combined with banking will probably be a growth driver as well going forward. So I wouldn't at this point in time, I'm not really worried about any other weakness outside of this impact of the cyclicality of the mortgage business.
If I were to ask you to, bifurcate the entire performance impact based on the seasonality which comes in form of furloughs and others, and the business weakness which is coming in because of the macros, how would it be?
I think let me just give you the entire revenue decline, in one shape or form was kind of led by the cyclical business. If I look at the seasonality impact, yes, it was there, but it was kind of in line with what we've seen in the previous quarters in other years. I think there were pockets of weaknesses. We called out our TMT or high tech business last quarter, where we saw the weakness creep in even in Q2. That continues to actually be a little bit sluggish. And then, of course, we have select one or two clients where, given their cycle, linkage to e-commerce and volumes, I think there is a little bit more weakness there. But I think broadly, the rest of the portfolio has really been much less impacted, despite the seasonality.
You spoke about 5 large deals coming in the quarter, 60% from the BFS space. What is the kind of range of these deals? What I saw in your metrics was that you increased your more than 20 million clients by one in the quarter, remaining very stable there. So which bracket those big deals come in?
So I think the largest deal was over 100 million that came in the banking space. But there are deals that are in below 100 as well. So cumulative number of deals of 400 plus million is fairly broad based. Besides that one large 100 million plus deal, the jump in the 20 million plus category, actually, you pointed out right. It is definitely linked to a large deal that was sold to a new customer in the current financial year, and I think we're very pleased that not only are we selling large deals to existing clients, we're actually selling large deals to new clients as well. And this quarter also, we have a couple of those large deals have gone to new customers. So I think fairly broadly balanced, TCV performance across verticals, across client categories. And despite that level of conversion, we are actually seeing an increase in pipeline sequentially 6% and YOY 27%, which means not only are we converting deals at a good clip across segments, we're also actually originating new deals at a faster clip.
On a book to bill ratio 1.1, 1.2 or so, do you expect that to be maintained in the coming quarters?
Yeah, I think a slight nuance there. We announce only net new TCV. Right? So when you look at the book to bill, it's actually be much higher than what you're looking at with the TCV number, because we don't include renewals like many of our peers do. So from that perspective, I think maintaining a TCV run rate, which has progressively, by the way, increased over the last 2 to 3 years. It used to be in the 200 million range just about 2 years ago. We've doubled that at the current clip. We do believe that the strength of the pipeline gives us confidence that we should be able to see a pretty healthy trend on the TCV wins.
So if you were to add renewal TCVs, how much will that be?
We don't give out that number publicly. Of course, the TCV also has its own color. Some deals are longer term, some deals are shorter term. But if I look at our core BFSI business, typically duration of deals is not as long as you will see in some other verticals, but the renewal rates are very high for us as well. So I think just the correlation between TCV and revenue at 85% should give you a sense that there is pretty strong correlation between new deals won and revenue growth.
Manish, EBIT margin at the lower end of the guidance, you are aspiring for 17%. What is going to be the exit rate for you in Q4?
When we started the year and gave the guidance of 15.3 to 15.3 to 17, the market expectations were softness in margin across board, and we guided 15.3, which was slightly higher than Q4 to indicate that we are confident of maintaining and if not expanding the margin from where we were. The reason why we gave the range of 15.3 to 17 is because there were quite a few unknowns. Supply was still not sorted. And the assumption was if things fall in place, we should be able to report an expanded margin. As you know, supply has eased in the last few weeks, but it is still to be at a place where we would like it to be. And couple that with all the macro headwinds, the revenue environment has also changed. This is why instead of being over towards the upper end of the margin, we are closer to the lower end. Having said that, this particular quarter, we had quite a few things falling in place. Our ability to get freshers build, which is the fresher engine that we had been working on, has yielded result. We also realized that we can live with less bench than we were earlier, given the supply situation is easing out. So we improved the utilization as well. And that, along with all our investments that we had made earlier, we were able to continue maintaining the margins despite the significant drop in the revenue. While typically when there is a revenue movement, we are able to manage the cost in line for the digital risk and the mortgage business. But unfortunately, the decline was very sharp, causing an impact on the margins. But despite all of that, we were able to maintain the margin at 15.3. What the Q4 number will be, I think we don't give a specific quarter guidance. But what we expect to have in the next year, I think we will talk about it when we get to Q4.
No, I'm from my point was that you for 9 months it's around 15.3. Will you be able to bring it up on the in the middle or increase it given the kind of leverage now that you're talking about which you have?
There are certainly tailwinds. There is a northward bias to the margin, and it should certainly see an improvement on the reported basis as well. Whether it will happen in Q4, how much it will happen in Q4, I think that's something that we don't talk specifically about.
What about the on-site and offshore? Because your revenue contribution from on-site has fallen and offshore has gone up. Is it a conscious effort to use the bench offshore to bring in the leverage here?
To some extent, it's the result of the softness in mortgage business. But yes, even otherwise, there is a bias towards offshore business in the pipeline, in the TCV wins. And, even from a client's perspective, they are expecting us to execute some of these contracts with an offshore bias. Remember that, we have had an acquisition of Blink that kind of added to the on-site percentage. Otherwise, over a sustained few quarters, we would have seen improvement in our offshore mix, which has been a conscious effort from the business perspective.
Okay. Give me a sense of how the employee addition is looking at, because on a net basis, we have fallen in Q3. I'm seeing a trend of that in IT services companies and your large companies as well. You don't have that kind of demand visibility as you had, I think, in 21, 22, early 22, because of which you are now, recalibrating your supply situations, or most companies are doing it, but you also?
Yeah, I think it's not so much a demand-linked situation as much as a supply-linked situation. I think when we had a very tight labor market, the entire industry and us included, built up a fairly large bench, including fresher bench. What we are now doing is we are optimizing, given the fact that we've now learned how to absorb those. I think there's a little bit more flexibility available in doing a lot more timely onboarding of people instead of holding them on bench for a few months. So that's one aspect. Second aspect, I think we are all obviously looking at what kind of skills, how do we reskill people, how do we fulfill internally by moving them up, a lot more than the just-in-time hiring model that our client, because the growth was running at a much higher level across the industry. We were actually doing near-fit hiring, reskilling them. So the lateral bench also has reduced as a reflection of the fact that our confidence in creating those skills internally is higher today. I think both of those are contributing to the fact that we are more comfortable in a high utilization range, and we still think our utilization can actually go up as the revenue momentum continues to pick up in the core business. But I think overall, a lot of work's been done in creating constructing a pyramid, optimizing the lower end of the pyramid, and we'll continue to focus on expansion of that pyramid at the lower levels by creating that reskilling mindset that I just talked about.
Has the stay on the bench reduced a bit in the last quarter? And by how much? I mean, what was the average stay earlier, and what is it now?
I think the utilization is probably the best metric to look at it. We improved utilization last quarter. We improved it again this quarter by about 2%, which gives you the fact that the aging of the bench is actually reducing in a proportionate manner as well. So absolutely right. The aging of the bench is reduced. Aging for lateral bench is reduced dramatically. But of course, we are still carrying freshers, and we will continue to incorporate them in the supply chain as we get into a Q4 and FY24 as well.
What's happening in the IT spend space, and especially you spoke briefly about some of the macros which are impacting you, but from an IT spend space and clients perspective, are they open to giving out orders, or is it taking longer time to close the deals? Your TCV wins gives us a different thing, but was it some of the things which have been moved on to Q4 because of which you had a 400 plus TCV win, or is the process normalized? Because we're hearing that the process of closing deals is taking more time. Yeah.
So I think there is the client budgets, at least in the segments we are playing in. There are definitely pockets of weakness as you think about linkage to core capital markets within BFSI, or you look at broker dealers. But I think broadly, I wouldn't say that the budgets are declining. Even if they are being held flat or they are steady, there is definitely a microscope on where the spend is going, right? And I think the spend is kind of getting more and more concentrated in areas that impact things like the refresh of the tech stack, because that has a cost implication. Right? So adoption of all things cloud, especially the public cloud infrastructure away from data centers, and modernizing your data estate using some of the cloud technologies, whether it's Snowflake, whether it's BigQuery, using all forms of modernization on your customer service contact center to eliminate costs that sits there, and of course, finally, any form of cost takeout. Those are definitely much in demand. So anybody who's aligned to those trends will see good value TCV wins, which is what we are seeing as well, because we are definitely aligned to those trends for a long period of time. On the issue around decision-making cycles, timelines, definitely caution crept in towards the end of the year. Despite that, we were able to actually get to our second highest TCV quarter. So I think that should tell you that the strength of the pipeline and the ability to convert and the ability to continue to originate in those themes that are very much in demand is, I think, something that we'll continue to stay very focused on.
You're confident of getting the same amount of TCV every quarter, the run rate?
Yeah, I think, as I mentioned, right, without commenting on a one quarter TCV phenomena, I think you should look at the trend. On a trend basis, this is, as I said, the second highest ever. We had one previous quarter of over 400. I think the confidence comes from the increase in pipeline and, of course, the shape of that pipeline, which a lot of the details available, whether it's sector level. I think BFSI is still a big part of the pipeline, but there is an 86% growth in the non-BFSI pipeline year over year, when the overall pipeline has grown 27%. And BFSI itself has actually grown in pipeline as well in that same period. So I think aligning to the trends, focusing on the micro, account by account, making sure that we're able to originate deals, being very proactive in creating solutions to customers, not waiting for RFPs to be issued. I think all of that has worked for us in the last few years and will continue to work for us as we go forward.
Manish, a couple of questions. Your effective tax rate has gone up this quarter to 25.2% on a quarter-to-quarter basis. Any particular reason for that?
If you look at from a YOY basis, last year, same quarter, we were at 25.4 and now we are at 25.2. And, on a quarter-to-quarter basis, there is a change in the mix of business. There is a difference in how much is on-site, how much offshore. All of that kind of impacts the margins. But at an overall level, when we did our assessment, we believe we should be in that zip code of 25%. So I don't think 24.9 going to 25.2 is indicative of any directional movement. It is just the quarter-on-quarter mix change in the business leading to a change in the effective tax rate.
So move away from on-site to offshore will have an impact on the effective tax rate going forward?
So every jurisdiction and every market and the kind of work we do, all of that, has bearing on what the effect of what the tax will be. It's difficult to exactly say whether on-site versus offshore only makes the difference. But yes, the mix has an impact on the margin, the tax moving by the marginal 0.2, 0.3%.
Okay. What about the DSOs and receivables? It's been increasing. If you look at on a Y-to-Y basis, from 59 to 68 days, from December to December. What's the reason for that increase?
So most of our customers, we are able to collect money exactly dot on time, and our contractual terms have not changed much. So we pretty much believe that 60 to 61 days is where the DSO should be. What we have been able to do over the last few quarters is win quite a bit of business on our zero cost transformation archetype, wherein you typically try and flatline the cost for the customer, while from an accounting perspective, you manage the revenue and the cost in line. So you are spending more in the beginning, but you are accounting the revenue and cost in line. So what that translates to is you would have invoiced the customer, but you would collect it later, or you would invoice the customer later. But it is all protected from a contractual perspective. So this structural investment in winning business leads to a certain portion of the receivables locked in for a little longer period of time. And if you knock that off, we would pretty much be in that same 59 to 60 days DSO zip code.
Are you saying the new deals are coming in with those clauses where they have more customer has more time to pay you?
No, I think it's not about giving customer more time. I think it's the way you structure a 7-year deal or an 8-year deal, because you're actually taking cost out of the operation, but it takes you 2 to 3 quarters to implement those cost levers. This isn't something new, but given that deal wins have been pretty healthy in the large deal category, I think some of that's showing up in the DSO line.
Yeah.
So as you have large deals and long-term deals, this is going to be a stay here. Is that what you're saying?
I think the right way to think about it is that the reason why we want to create operating leverage in the business is so we can invest with our customers and actually be more competitive and aligned to their outcomes. And we'll continue to, of course, manage the metric. I don't think the message is that the number will continue to deteriorate, but there will be, ups and downs based on, what type of deals we were done a quarter or two ago and what kind of pipeline we run. But I think on an overall basis, the CFO's office will continue to manage the receivables in a way that it continues to be within the zip code.
No, because I was asking because Manish said that the level of 60, 61 is something which you aspire, and you are at 68, and we're seeing a continuous trend of going up since last December. So my question was that, is this a trend?
No, I think
is it going to plateau out, or it will going to decline going forward?
I think the way to think about it is, given the philosophy that we have articulated on the profitability, it is pretty much the same here as well. It's a conscious choice. Whenever we do a deal where we decide to have delayed collections, the cost of funds is kind of baked into the price, and we make margins after that cost. And we also make sure that we have done our due diligence on the credibility of the customer so that there is nothing at risk. Whether we want to increase that or decrease it is not necessarily driven by what is our optically reported DSO, but what is economically the right thing from the company's perspective. I think we have the ability to flex it up or down as we want, and we don't necessarily do this for every large deal. It is done based on specific situation and based on our consideration on whether that makes the right choice, that's the right choice for that particular deal or not. So it is very much a conscious choice. It is not that we are trying to win deal by offering something which is detrimental to our business. It is, in a way, if you think about it, using the cash to generate more business at economically the right margins.
Nitin, finally, how do you see, if I tell you to look at 23 as a year, do you see headwinds in the first half, or you think some normalization coming in the second half? How do you foresee the business given the kind of macro headwinds that you're seeing in some of your business?
Yeah, I think, if you leave, we had a detailed discussion on the mortgage business, so I won't double click on that again. But if you think about the rest of the business, I think staying focused on account level, micro actions, mining each account, focusing on strategic hunting, driving those new engines of growth that I talked about outside of banking, Of course, making sure that we continue to win wallet share with existing customers and increase market share across new customers through the strategic hunting. I think if we continue to do that, there is growth available, especially in the core business. When the cycle will turn, it's absolutely impossible to predict given geopolitics at play, the nationalist interests across multiple countries, focus on, this massive fight against inflation worldwide. So I think it's a very hazardous job to guess when this will turn. What we are really doing in the meanwhile is continuing to stay focused, as I said, on bottoms up, account by account, customer by customer actions that give us the growth and the TCVs.
Gentlemen, it was a pleasure talking to you today. Thank you very much for joining us on BQ Prime.
Thank you.
Thank you.